Welcome, everybody, to our Straddles and Strangles webcast. I'm Connie Hill. We get to enjoy these two strategies every Monday at this time. So I'm happy to see you here, whether you're somebody that joins me frequently, and I recognize your names here. Appreciate seeing you here this morning. And we could have some new people as well. Want to make sure that you feel welcome in our conversation. You know, we've talked about these two strategies being somewhat speculative, meaning probably not your bread and butter strategies. But one thing I really want to focus on today is the quality of the stocks that we use and the characteristics that we're looking for, because it can make all the difference in whether you have a winning trade or a losing trade with these kind of strategies. All right, so let's get going with that. I am happy to see Cameron May out in the chat. Cameron's a great coach and a great friend. And he's here to help maybe answer some questions I can't quite get to or that might be a little bit off topic. He'll have my back there. So thank you. Appreciate you being here, Cameron. And I hope you're following both of us on X. I'm Connie Hill CS. Cameron is Cameron May CS. Post educational content out in our X account that might be useful to you. So it's free. Follow along. Would love to have you there. All right, let's go through our disclosures here, and I'll lay out our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and informational purposes only. Don't consider it a recommendation. The Paper Money software application is what we're going to be using. It's what you download to your computer. It's the most robust version of Thinkorswim. Looks a little bit different than the web. Looks a little bit different than your mobile version. Investing involves risk, including the loss of principal. One thing with Paper Money that we try to make you aware of is that one functionality it does not mimic is the assignment of options early. In a live account, that can occur where you do get assigned early. In your Paper Money account, it won't do that. So I try to draw your attention to those times when maybe we might have seen that situation, but it didn't actually assign us early. Everything that we talked about is for illustrative purposes here, including different symbols that we might bring up. Past performance is no guarantee of future results. Now, typically in our class, we're going to go take a look at the trades that we had going on, what happened with them. And I like to do those first because a lot of times, those are some of the questions that you have. If you've been paper trading the strategy with me or example trade, in your paper account, then you might have particular questions. In fact, some of you will hit me up in other meetings. You see me in the chat and you're like, hey, what happened with this particular trade that, what's going on with it? So I know that you want to do that. And it also helps us as we're looking at new stocks or new positions that we're going to put on, if we have kind of a frame of reference of what happened the last time and could it influence the next time. All right, so let's get to it. We're going to head out and start out here on my Thinkorswim platform. And let's close this up. We don't really need that side right now. Our first trade we're going to look at that we did last week was Lululemon, right? Stretchy yoga pants that are all the rage. Well, you can see trend-wise, they've really struggled this year. This is not a total picture because I kind of zoomed in here, but you can see up here was over $200, got down here near 160 or so recently, and then it had its earnings announcement. Now I'm going to just kind of zoom in so we're seeing. That's not good. Let's maybe go like this. All right. Because I want to show you from when we got in and what happened after the announcement. Now, these guys announced on, they announced, well, let's go down here and see what the exact date was. We got in a little bit early because our class is on Monday. They didn't announce till the 17th after the market closed. And so the first time that we were looking at trading the information based on the earnings was the next day on the 18th, which was Wednesday, okay? So here's their earnings announcement that day. The next day, well, actually, the next day was a really volatile day. And I was thinking the initial reaction with Lulu the night on Tuesday night was a negative response. I could be wrong, but I'm thinking that's what it was. And then the next morning, it was quite a bit positive. So the next morning, it moved from where it closed here, 159.27, gapped down initially, kind of going along with the flow of the news. It did not gap down a tremendous amount that I was necessarily convinced that it was going to continue to go bearish. Okay, it's not convinced of that. And then as the day wore on, in fact, this happened pretty early after the market opened. It just started to rallied really big. You can see it got up there as high as 169.40. Now it hasn't gone to 169.40 yet. Again, I should say. All right, so on this day, we were able to determine, okay, we're going to go with the bullish trade that we put on. And we had on this one, let's see what we had. Trying to remember if we did a straddle or strangle. And my mouse is being a little weird on me. We did a straddle. We did the 160s, which was the at the money long straddle. Lulu makes really big moves, which is why it was a good candidate. In fact, it had 9.5% priced in into the at the money options for the volatility, which is indicative of we're expecting a big move. Now you can see I've got the market maker move on the screen right now. It's only saying 2.1%. Well, the earnings has actually passed. So don't worry about these lines for now. When we got into the trade, yeah, they were really spread apart here. Okay. So this morning we decided we're going to get rid of the put. And expect the call to take us the rest of the way. Now in these trades, we shell out money. We bought a long call and a long put, the 160 strike price, and they were kind of expensive options because you can look at the stock, it's a $165 stock. So let's come over here to, I want to just show you the account statement on Lulu. And so we paid for those, the 160 column put, we paid $18.15, which is really quite pricey, okay? And on these announcements, we expect really big moves, okay? Let's see what time it was when we said, we're going to go with the call. Let's see what we can get out of the put, which we sold for $290, okay? And that looks like about 7:48 is when that got filled. So it opened, and within about 12 minutes or so, we had an idea of where, I guess 18 minutes, an idea that, okay, really it was going to run bullish instead of bearish. Okay, so we went ahead and did that. Well, what does that mean? That means, and we sold both our contracts. That means we're planning on the call doing a good thing for us. Now, one of the things that I did is I put in, not in our class, but after the fact, before they announced their earnings. So I put this in on, let's see, I guess the 18th. I said, you know, if we can get a 30% gain on $18.15, regardless of where it comes from, if it comes from the calls, the puts, the combination of the two, let's go ahead and get out of one of our contracts. And so you can see I had it sized up here for just one. So maybe we get an initial gain and then maybe we hold on to one more contract and see if we can go a little further with it, is the idea there. Well, it did not hit this. It was not even close to this 23.59. Because why? Implied volatility just crashes as soon as the news is out. These options were a little expensive to begin with when we saw that their prices were a little bit inflated because of that implied volatility that was priced into them. And so the implied volatility, it just comes out, just comes crushing out. And so then you have two premiums sitting there, your call and your put, that are significantly less than what they were when we got into the trade. Okay, so we paid $18.15 for them. So that means we need a really big move to make up the difference. Okay, so what I did is I took $290 minus the $18.15 and said, okay, that now needs to be our break-even point, which is $15.25. Well, as we look at the chart here, it wasn't even up to that point here at the highest point. But when it pulled back and it closed here, I was like, okay, let's see if this will continue to run for us. Ran a little bit the next day, did not, went actually backwards the next day, or on Friday, you can see. And then today, it's up a little bit, but we really need it to move quite a bit more to be profitable on this trade. Okay, so that's what we're looking at here is, let me go back to our values we're seeing here on the screen. So we are up we're still down a little bit here. It's made up some distance today by going up, but we need it to go up significantly. Okay. And so the number I'm looking at here, our break-even point is let's see. Where did it go? 1525. That's what our break-even point needs to be. Now, did any of you do this trade in your paper money account and have questions about it? I know somebody asked me specifically about this trade Wednesday morning, and I said, hey, we ended up getting rid of our puts because stock wasn't going that way, and we're counting on the call to run up there. Okay, so far not looking profitable, but we have the rest of the week. And really, we're in a situation where, yeah, let's give it the opportunity to go up because it hasn't really pulled back significantly. Yeah, Friday had a little bit of a pullback, but it still is in a situation where you're like, well, that could continue to go. The momentum is starting to shift that way. The MACD looks like it crossed over the zero line this morning. So that gives us an idea that momentum's starting to swing to the bullish direction. All right. The other trade we did was Oklo. You guys remember Oklo? This is an energy company based on nuclear energy. And so we can see, I mean, it had some times that it was really flying high. We typically were seeing some decent size moves in Oklo, more so recently than earlier last year. So you can see, I guess, right. Let's see, get on the right exact day here for the earnings. They typically announce after the market. So the previous earnings had a little bit of a move, not a huge one. Okay. In any case, let's get over to where we were. So they announced their earnings. They popped up a little bit, but it just did not really stay there. And you can see the momentum just pulled away, but it didn't make that big of a move yet. Okay, you can see, yep, it's gone down. That means we got rid of the call and we're like, okay, let's make money on the put here, which is what we're looking for. Right now, the break even, we need to make 548. We come back over here and look at the trade. So we're still down on it. In fact, we're down quite a bit today. We've got the 2 contracts still left. We're on the puts. So we really need it to make a bigger drop to really even get to our break-even point. Okay. So the moral of this story is with both these trades, even though the expectation was for a big move and a lot of implied volatility priced in it, if they do not move big, and we've done the long straddle or the long strangle, then we have a hard time getting profitable on those trades. Okay. Now, Lulu typically had been an enormous mover, but and it did move that day, but it just isn't moving as much as we need it to, or at least so far, right? I mean, this move on this earnings from here to down here, that was a huge gap down. And then it continued to fall, right? So when you see this in here, big gap down, here, big gap up. So when you see those big moves, we expect that kind of movement. It just didn't give us that kind of movement yet. All right. Looks like we have a survey out in the chat area. It's survey time. Now, if you're new to our classes here, you might not know that once in a while they'll throw a survey out there at random. I don't control it. Cameron doesn't control it. To get your feedback on our session. And it's a really easy survey. There's 2 questions. You just pick the multiple choice on a scale of 1 to 10, plop, plop, you click your number, whatever you feel. And then there's two places. If you want to put in some comments, you can. Ask about maybe some things you'd like to see. I also encourage you to write other things in there, like things that you're struggling with, or maybe some aspect you'd like me to cover in an upcoming webcast. I love for you to use the space for that as well. Okay, so Cameron will post that again before our session is over. He'll probably post that a couple of times. All right, have a request here to look at GEV. That hasn't been one of our trades, okay? So it's not on my agenda to really cover here today. GEV has had some very big moves though, absolutely. Okay. Let's see, they are saying the SPX crossed above the 200-day moving average. We're getting a little bit of a nice bullish recovery type move today, aren't we? Amazing what can happen when we say we're not going to keep bombing. We're going to have a hiatus of bombing the area of tension for 5 days. Man, the market really reacted to that, really liked that piece of news. Yeah. Okay. Let's next move to some stocks that are having some earnings coming up. We're in the kind of this phase where it's maybe some retailers that we run into that are having their earnings. They're usually report a little later in the season. So we're seeing some of those come on here. Now I'm going to bring up the problem children first, okay? And it's not that they're problem children so much as maybe we're not going to use them, okay? Now I have KB Homes, and we can see maybe some big candles when it's moving. We can see a little bit of a gap and a big candle here. So it has been a decent moving stock over earnings. Now, earnings is not the only time that people might use a straddle and strangle, but it's any time when they're expecting possibly to go long on it, the straddle or the strangle, a big move. Okay, that's what the expectation is. Now, we can use the market maker move to help us out. What is the market maker move? Well, it simply is the amount of implied volatility priced into the at-the-money options for a particular event. Now, in the event we're talking about, it's with earnings, but it could be something else if it's a product announcement type thing coming out for a company. Maybe it's an FDA announcement where you know in advance, hey, they're going to let us know what they think about this drug we have going through the process of being approved. And so sometimes those will be really big moves. Or sometimes a situation where I've seen it used is if a lawsuit is supposed to be settled on a particular date, then a big move is expected, because if it goes the company's way, they might get a pop. If it doesn't go the company's way, maybe it's going to get another drop. I shouldn't say another, but a drop. Okay. So I want you to know there are additional situations. Let's see. For us trading in an IRA account, does the fact that we can't leg out of the put on the straddle trade limit this approach? You would have to be in a short the option for that to be a factor. If you're doing a long straddle or strangle, right? Straddles where we buy at the money, so the same strike price. A strangle is where we buy out of the money, so a little bit out of the money on the put, a little bit out of the money on the call. You can exit either one of those without a problem. So I think what you're talking about here, option 66, is this idea of not having a short option covered, basically. Yeah. And I would say, yes, that definitely should be a consideration. And if you're doing the short ones, doing the short straddle strangle, then yeah, that definitely is a factor. All right. Let's, why, this I put on we're not going to use list, okay? Why are we not going to use this one? I wanted to open up my side here so I could shoot out to you this market maker move on the chart so that you can visually see it. Okay, this is a script. I would like all of you to be able to have access to it, so I'm going to post it out here in our chat. Remember, anytime we share a script with you, it's never guaranteed as to accuracy or timing. Those of you that are listening on the recording, what you might need to do is pause so that you can see this, or let me just do a little text box here, temporary text box, and I'll paste it in here, except I'm going to get rid of all of that. So we just have the actual formula. All right, starts with that exclamation point. You just do it exactly as it is because it's cap sensitive, okay? Now, this one, it's saying that 5% is priced into the at the money options. So it's not huge, but sometimes maybe we want just a little bit of a move and not expecting big, huge moves like Lulu, which didn't produce for us, okay? When I went to the trade tab, however, we're really limited on the options, and this stock does not trade a huge volume. I mean, 564,000 for the stock itself is not that bad. Now, the prices have improved a little bit since I looked. On the call side earlier today, the spread was about $1 on the call side. The put side, not so much, which there's a little bit more open interest there out of the money and at the money. In any case, like, we're just not going to use that. The pricing isn't there, and liquidity wasn't there when I was looking at it. And so we're not going to use it for that reason. Liquidity of options is one of the biggest things you want to look for. If we're looking for qualities and characteristics of the stocks we want to use for the strategy, one, it's typically big moves if we're going to go long a straddle or a strangle. And the second thing is the liquidity of the options. Now, I'm going to bring up here. Let's go to one that you guys might recognize is a big mover. We're going to go to Chewy. So let's pull out, there we go. We've got the whole year here. And so I want to just point out that what it's done in the past. Because if it's not a big mover in the past, we might not want to use it for this strategy. Now I'm just going to zoom in here a little bit. This first move was not enormous. Yeah, it kind of gapped up and pulled back, but that wasn't really that big on that particular move. However, this earnings, yeah, we saw a big old gap here, and so we're going to be looking for gaps and for long, big candlesticks, tall candlesticks, okay, is what we're looking for to determine, hey, does it move big over earnings? So yeah, this one had a decent sized drop there. So it dropped and then came down and kind of rallied up here a little bit. And then after that, started to be a little bit more bullish, trying to recover the big gap. The next earnings, what did it do? Well, it had another big gap down. Some of these retailers are really struggling right now. Chewy is no exception to that. These are the guys, you guys might use them in your situation. They have products and supplies for your pets that they can ship to you, so you don't have to go to the store. And so let's see. This was a decent gap up and drop. Okay. And then that brings us to today. All right. So they're due to announce earnings here on the 25th before the market opens. So today's the 23rd. The 25th will be Wednesday morning before the market opens, when they are going to put out their news, which means the 25th is going to be the day that they react to the earnings. So we might be able to see it pre-market, what the initial reaction might be. When the market opens up and we have all the participants participating, it's not guaranteed to stay there. Okay. Look at the implied volatility priced into here, 10.44%. Now, is that pretty big? Yeah, it is. That's on the bigger side. Okay. Now, one thing about Chewy, and actually all the examples I've used today, I'm being a little bit price sensitive, meaning Lulu was a really expensive trade to put on, and it just didn't pay off because it didn't move big enough. So this is a stock that is a little bit lower priced, so the options are going to be a little bit lower priced as well. On this, I'm thinking we are going to do, let's come over here to the trade page. We can see the implied volatility that is priced into here. So the ones that expire Friday, this Friday, has 135%. That's a lot. Okay, that is a lot of implied volatility. And then it drops off the further we go out in time. So that means these options are really a lot more expensive for that implied volatility piece of the premium. Not as much here on a week out, but still fairly high. There's still a 20% jump from the second week of expiration out to this third week of expiration. Okay. And then we see it kind of drop into the 60s, which is kind of its normal range, not anticipating any earnings or big news announcements. Okay. So sometimes we might think, oh, well, let's do something with, let's sell some premium here. And that can be a possibility. On the one that we're going to do today, because it does typically make big moves, I wanted to do on this one the long straddle. Okay. And I want to come out here to, let's see which ones we wanted to use. I can't remember if I ended up deciding. Yeah, this one doesn't have a lot of open interest out there, right? Do we want to get involved in those kind of contracts? No, we do not. Okay. This one was a little bit better, but still a little bit wide on the spread. So we're going to go out here to the monthlies. Now on this one, oh, do you know what? We're not going to do a straddle. We're going to do a strangle here. These are the monthly options, which should have more open interest because they've been out there longer. However, you can see there's a lot of open interest here with 000, 000. Well, that's because they introduced some strike prices that previously have not been there. Okay. And so they're just barely starting to trade. But you can see there's a lot of open interest out here, say at the 22.50. So the at the money, if we were doing it, would be the 24. But because the spread's a little bit wide there, there's not a lot of open interest. That's why we're going to say, okay, we're going to do the strangle then. So we're going to buy the 22.50 put here. And I'm going to hold down my control key while I click on that ask price. And then we're going to do the same thing. We're going to go out of the money a little bit. The deltas are fairly similar here. Well, this one's a little bit lower. The call, we're going to have to pay, looks like maybe about 10 more cents for, so a little bit more expensive. But you can see lots of open interest, and that bid-ask spread isn't too bad, and we'll try to get filled at the midpoint. Oh, let's get rid of that guy. There we go. There's our Chewy trade. So we are willing to spend $3 on it, okay, to get a big, potentially a big payout. Now, the strategy here is hopefully the market will determine for us fairly quickly if the bullish side looks like it's going to win or the bearish side. Whichever side looks like we're not going to be using, we're going to try to sell it immediately and see what we can get out of it. And there's some different strategies we can use for this. One, we can watch and just kind of see what the price is. Number two is something we did last week. We had success on one of our trades and not the other. And what we did there is we could see which one was in a losing position. And we went in and put a limit order just sitting out in our working orders for when the market opened and said, all right, if we get 50% of it, it might have been 40%. I can't remember which of those I used. If we can get 40% of it, great. We'd be happy to exit the losing position for 40% of what we paid to get in, because really that helps the trade out quite a bit. And on the trade that worked with last week, it ended up being a nice profitable trade for us. And part of the reason for that is we were able to salvage something decent out of the losing end, okay, of that trade. And then the other one made a nice move for us. Okay, so there's different ways that we can approach this, but it's all going to be based on how big is it moving and what direction is it going. What we did last week, and I'm going to do it again this week, is we're going to do 2 contracts. And the idea with 2 contracts is if we get a big, say a big pop or a big drop, and let's say we get a drop because Chewy's kind of been going down. Say we get a big drop and we decide we're not going to use the call. We'll try to just salvage what we can out of it. Okay, we'll put it out there. we'll probably more likely than not do a limit order so that we're controlling the price. A limit order doesn't guarantee that we're going to get filled on it, but it gives us a little bit better control than just putting a market order out there that we could get filled at any price. And when it's the very first thing in the morning and the prices are jumping all around the place, sometimes you just don't get that great of fills. Sometimes we have to resort to that, but typically we'll start out doing a limit position on it. Okay. And so then we might sell one of the legs and see if we get a little bit more distance out of the other leg that we hold on to. Okay. So we'd sell whatever way is not going. We're going to sell both contracts. Then we get a decent gain. We'll sell the first contract of the, say in this case, say it was to put because it has been falling. Great. We'll see if we can get a little bit more out of that trade with that second option. Does that make sense, you guys? All right. Let's go ahead and we're going to put this in our straddles and strangles bucket. And look at another one. All right. There was a question here, why Chewy and not GE? I'm not sure if GE is on the list of earnings this week. They very well could be, but I'm thinking they already announced earlier. And so we're really focusing on stocks that we're thinking might have a big move, but we just don't know which way it would go. We don't have an inkling if it's bullish or bearish because nobody does, right? We all got to find out together what the situation is. So a question here says, so we watch this trade and hold it longer, maybe one of the legs, depending on how is situated. Now, if we get, say, for example, and something that I'll do before we get to the earnings date is, and we could have done it right now. Well, okay, let's go ahead and do it right now, okay? If we were to get a percentage better than our net debit, say 30%, 40%, 50%, we could put a working order in there if that's something you'd be happy with. You're like, hey, I get 40% off that trade that didn't last very long. Sweet. We could go ahead and put it out there right now. So let's do it. Let's do it with, let's say, would you be satisfied with 30%, you guys? We're going to go 2.56. I've got my little calculator here. 2.56 times, should go 30%. Your number may be different. And my calculator says that would be about, no, that's not right. Let's use this calculator instead. Sorry, I was using my hand one and it wasn't working so good. So let's just show the numbers here. 2.56 times 1.3 is 332. We can put it in and just say, hey, if you get there before it announces, great. We're happy. And sometimes that can happen if implied volatility continues to ramp up going into earnings. It has a couple more days for that. But let's go ahead and put this in 332. Just going to put that little number there. So let's come down here. Chewy. And let's do create a closing order. And let's go ahead and put that in at 3.32. Now, if you're not satisfied with that, then you wouldn't do it. Or you might use a different number if your number is 40% or 50% or 100%, right? You could put whatever that value is that you would be satisfied with to get at any point in the trade, okay? Let's go ahead, let's put that on as GTC. Now, let's look, I wanna get another one on here. And this one, we are gonna do a little bit different, okay? Carnival Cruise, all right? Kind of pulling back here with the price of oil, right? Price of oil sparking, not sparking, the price of oil jumping, right? Kind kind of at extreme measures is really taking a toll on some of the travel stocks and those that really rely on that fuel price. So they've taken a little bit of a hit. The market maker move that's priced in here is 2.6%, which is kind of, it's significant, but it's not extreme. Like Chewy at 13%, that's pretty extreme. That's really high. So on this one, we're going to maybe take a little bit of a different approach. Now it's a lower price stock. And what if we could maybe capture the implied volatility priced into these options? Okay, so we've got a 92% implied volatility into these options, and this is based on going up $2 or minus $2.06. We don't know which direction it might go. And then look, it drops down here to 74 and then 67. Okay, so with this trade we're going to do right now, we are going to attempt to get some of this implied volatility, right? So stocks trading pretty close to 26, so that's going to be our at the money strike price. So instead of buying the option, we're going to sell. Okay, so I'm going to put, I'll start on the put side, hold my control key down, and I'm going to click on the bid price for the 26, the bid price for the 26 call. So we've got both of those. That's a $1.93 credit, which we would like to hold. Now, a question came up earlier here about, you know, if you're doing this in an account where you cannot have a naked option, is that a consideration? The answer is absolutely. That is a consideration. Okay. So what we might want to do is, number one, to limit our risk, is we might buy something a little bit, buy an option a little bit out of the money so it doesn't cost so much. And so that's what we're going to do. So we're selling the straddle here. And then what we're going to do is we're going to buy a strangle. And let's see here. I think we're going to have to use, these will work okay. This is a little bit better than it was earlier. 68.81, 97, 115. Actually, let's just take a peek at the 17, see if they actually are a little bit better priced. In terms of the spread is what I'm looking at here. Yeah, this is a little bit better. We're going to go out of the money on this, okay? We're sometimes if you want like just to be covered for that risk, but you don't want to pay a lot for it, you might go out of the money. And so what we're going to do, we're going to buy a strangle that's out of the money that, yes, it's going to take away from this credit initially, but we might get mileage out of it after the trade has gone through and determined a direction, and the implied volatility comes crushing out of our short straddle, then we're going to be left with our long strangle. So let's go ahead here. And we're going to do the 23 on the put side. So I'm going to hold down my control key. And then that's about a 22 delta. Let's see what we have here that might be comparable. We're going to have to come out here. Let's see, stock's at 26 and this is 23, so $3 away. And so our option that's $3 away would be down here at the 29. Lots of open interest there. And we're going to go ahead and buy the call here as well. So that cut our profits significantly, but it also makes the trade possible. And it gives us some coverage so we don't have that unlimited risk, right? A naked call is unlimited risk. The price could skyrocket and we'd be short the call and we'd be like scrambling to try to get out. But this is going to give us a little bit of hedge protection. Okay, that's why we're doing that. Sometimes that helps you capture that implied volatility, and then you buy your legs a little bit further out so that if they need a little bit more room to run to make up the difference or in the trade, then we do that. Now I'm going to do again here, I'm going to do 2 of each contract. Okay, so we're going to go ahead, we're going to put it in this way. So first trade we put on was a straddle. Second trade we're putting on is called a a straddle, strangle, swap. Now you're going to see over here on this left side here, it says double diagonal. Technically, this is considered a double diagonal as well because we're using different time frames, different strike prices. So that's why it's saying that. All right, we're going to set this up. We're going to hit it, send it to straddles and strangles. We've got some other ones to pay attention to. So we're going to have to continue to follow up on our first couple of trades that are still in there, Lulu and Oklo. Hopefully hopefully both of them will start making a little bit bigger move. But if it doesn't, then we'll not do well on those trades, but we'll continue to watch them. Any questions on any of these strategies? Because it's a lot for you. It's a lot to take in. We would not do the short straddle here if the implied volatility were lower or low. Okay, if there was not like a big separation of implied volatility, or say the whole option chain was just fairly low, then it would not make sense to use either one of these strategies. Okay, it makes sense to use it when the expectation is for a big move. Now, I do hope you're following Cameron and I on X. All right, Cameron may see us. I'm Connie Hill CS. Would love to have you follow us, pick up those little nuggets we put out during the week. I hope you are a subscriber to the Trader Talks channel. Why? Because it helps it make it so much easier for you to be able to find our content. Now I'm going to bring up a little screen here. If it'll go here. It's going on my other screen. I'm going to kind of drag it over here. You can see, gee, what's coming up today? Well, right now we're doing straddles and strangles. Next up is going to be trading a smaller account. Kevin Horner sitting in for Barb Armstrong today. And then you can see the rest of the lineup. Cameron's going to be coming up here in a couple of hours with his cover calls and short puts. Those are interesting strategies to explore as well. So just helps you kind of keep in the know. We also do some short videos and some that we call bite-sized content. We can see here's Cameron's latest one, spot this rare stock charge signal. Ooh, I wonder what it is. I think I might know, but I'm not going to blow it for Cameron's punchline there. In any case, follow it. Go ahead, give it a follow or a subscribe, and then you can see the content a lot easier. All right, you guys. That is it for the moment. So I'm going to turn you loose. Again, there was a survey out in the chat, and Cameron just put that out there again to make it easy to just go ahead and click on. And again, I appreciate your feedback, man. We read through everything that you send through. And again, I like to incorporate things that you want me to cover. I like to bring those up in coming lessons. So feel free to use that space to write in to give me that information. All right, you guys, top of the hour. We'll be back with Kevin Horner. In the meantime, go get a drink, refresh your snack jar or whatever you've got going on there, and we'll see you just in a few minutes. Bye-bye.